Welcome back to the Energy Signal Podcast, episode number 8, your weekly roundup for the latest trends, policies, and market movers shaping the U.S. and global energy landscape. I'm your host, Josh Lefebvre, joining you from the energy capital of the world, Houston, Texas. We are recording this episode today, Sunday, September 21st, 2025. In today's episode, we'll be discussing why oil prices slipped despite the Fed cutting rates, California Resources' $717 million bid for Berry Corp, and how regulatory shifts may reshape drilling in the Golden State, Cenovus' fair and final push for MEG Energy in a battle for Canada's last big oil sands prize, Trump pressing Europe to cut Russian LNG faster, how the clean energy boom that added 100,000 US jobs last year might quickly unravel, and then finally Microsoft's $7 billion bet in Wisconsin, building what could become the world's most powerful AI supercomputer powered by both solar and LNG. Stick around. You're not going to want to miss this episode. This episode of the Energy Signal Podcast is brought to you by Stage Tracker AI, the real-time frac intelligence platform that's powered by AI agents that help engineers and operators stay ahead in the frac game. Whether you're trying to optimize pump schedules, reduce NPT, or benchmark crew performance, Stage Tracker gives you the live view of what's really happening, stage by stage. No more waiting on the post-job reports to know if you're behind. Learn more at stagetracker.ai because every minute counts on the job. All right, on now to our commodities for the week. Well, West Texas Intermediaries oil, they actually dropped from $63.05 down to $62.75. This was a 0.48% decrease. Now, this drop actually comes despite the Federal Reserve cutting interest rates last week. Now, anytime that the Reserve cuts interest rates, this is normally supposed to drive up consumption. This wasn't the case. So this actually seems to be more so tied to the weak job reports that came out in July and August. However, many are still optimistic that they have not seen the full impacts from the tariffs that are being placed on Russian crude. So once those take to effect, again, this might actually drive up those West Texas intermediaries. The rig count also went up last week to 542 rigs in North America. Now, this is the highest since July. However, the total rig count is still 8% below last year's highs around this time. In terms of the Henry Hub gas index, gas actually also fell. It went from $2.95 down to $2.94. A very, very slight increase, 0.34%. All right, on to our big U.S. energy stock players. Our first up is ExxonMobil, ticker symbol XOM. They dropped slightly last week by about 0.57% from $112.82 to $112.18. Chevron also dropped about 0.57% from $112.82 down to $112.18. ConocoPhillips also across the board dropped by 0.74% from $157.38 to $156.21. So all three big stock players fell last week. And this comes again despite the Federal Reserve cutting rates, which actually caused most stocks in the S&P 500 to shoot up. The oil and gas companies, of course, are so heavily tied to the price of oil that they were mostly not affected by the Fed rate cut. On now to our deals and drills for the week. So our biggest deal of the week is California Resources, ticker symbol CRC, is acquiring Berry Corp, ticker symbol BRY, in an all-stock deal valued at $717 million. The deal follows a recent California law that would allow reopening drilling permits in Kern County. California, with its strict regulations, has often pushed producers out of the state in the past. Now, CRC will pick up Berry's C&J Well Services unit and its Utina Basin position in Utah, creating a much larger, more cost-efficient oil and gas producer with strong overlap in California. Now, this closing is expected to go through in Q1 of 2026. On that announcement, CRC's shares rose 5%. Our next story comes from, we discussed this a few weeks ago on Cenovus's bid for MEG Energy. Now, this merger would combine MEG's Christina Lake assets with Cenovus's adjacent operations, creating one of Canada's largest oil sands producers, an estimated 720,000 barrels per day. Now, this deal has since come under fire. MEG's board has endorsed Cenovus's offer. Their offer was at $27.79 Canadian. Now, this is despite a higher hostile all-stock bid from Strathcona Resources. So they've actually offered $30.86 a share. Now, CEO John McKinsey called the company's cash and stock offer for MEG Energy fair and final, arguing no precedent to support a higher valuation for a pure-play oil sands company. Now, shareholders are expected to vote on this on October 9th. Strathcona already holds 14.2% of MEG's shares, and they vowed to oppose Cenovus's deal. So essentially, this is intensifying this battle over one of Canada's largest oil sand opportunities. It'll be very interesting to see what comes out of that October 9th. On now to energy geopolitics. Our biggest story of the week is that the European Union is proposing moving the phase-out deadline for importing Russian liquefied natural gas up 1 year. So originally it was slated for January of 2028. It's now being pushed up to January 2027 as part of its sanction package against Moscow. Now, US President Trump has been the one that's been pushing Europe heavily to cut Russian energy ties faster. And basically, they're tying this cut, Russia's financing, to hopefully end this war in the Ukraine. Of course, Russia is using their oil and gas export money to fund this war. So it's only natural that these UN-based countries try to cut this off. Now, these European Union sanction proposal talks kicked off some pretty intense discussions among these 27 member countries. They're trying to reach an agreement right now, and Russian-friendly governments such as Hungary, Slovakia, they've previously held up, again, these companies, very close ties to Russia. Now, this shift could boost US LNG exports to Europe, as the Russian share of European Union LNG imports has been steadily declining. So it's fallen from 22% in 2021 down to 14% as of last year in 2024. So we'll see what happens here. On now to clean energy and innovation. Our first story of the week is that according to a recent environmental advocacy group study, clean energy jobs in the US grew 3 times faster than the overall workforce in 2024, adding 100,000 positions alone in 2024, totaling 3.5 million sector jobs. Now, over 80% of all new energy sector jobs last year were in clean energy, with the sector now employing 3 times more Americans than oil, gas, and coal combined. Now, this study went on to further highlight the risks to this growth under the Trump administration and their policies, which of course have rolled back federal support for renewables in favor of fossil fuels. Of those 3.5 million jobs, 2.4 million were in California, Texas, and Florida, and New York and Massachusetts, which of course lead in solar and wind employment. Our other big story for the week is Microsoft has announced that it's expanding its Mount Pleasant, Wisconsin campus with a second $4 billion AI data center, raising the total investment in that state to over $7 billion. Now, this site will eventually host the world's most powerful AI supercomputer using hundreds of thousands of NVIDIA chips. Now, this first data center is set to open in 2026 and employ 500 people at its peak. So this, of course, combines the area to have a total of 800 permanent jobs. Now, Microsoft is planning solar projects elsewhere in Wisconsin to offset the energy use, but acknowledges that new fossil fuels generations around specifically LNGs will also be built nearby. In addition, advanced cooling systems will aim to limit water consumption. So a relatively quiet week in terms of the energy sector. I mean, there's some interesting mergers and acquisitions on the horizons. Trump is continuing to push sanctions on Russian oil and gas, those who are still buying their exports. So, I mean, really really everything that we've already been seeing over the last couple of weeks. I think the biggest story of the week is, of course, the Fed cutting rates and the oil and gas companies pretty much staying stable, right? All other sectors we saw across the board have pretty much increased on that announcement. Usually when the Fed cuts rates, that really boosts up our economy. Businesses are consuming more, they're borrowing more. We're seeing people spend more money, traveling more, which you would think that would increase the price of energy, but just not simply the case. Now, as we mentioned, we still have yet to see the effects of all of these different countries that are slated to stop buying Russian oil. That, of course, could boost things for the US economy and the overall energy sector here, but only time will tell. So again, thank you so much for tuning in this week. I'm Josh from the Energy Signal podcast, signing out. Until next week, goodbye.